How's it going, everyone? It's Sam. Today we are looking at dividends, and dividends for Tesla specifically. Now, what are dividends? Well, a lot of people realize that they are a portion of the company's profits paid to shareholders. Now, a lot of people like dividends, especially people that are investing later, maybe in their investing journey. They realize that these are pretty much guaranteed, not exactly guaranteed, but companies like to keep them around, and it's something that they want to continue to pay out if they've already set a precedence for it. A lot of companies will continue to grow their dividends over time. So if you buy in, 20 years ago, you could be getting a higher yield now based on buying in the past, especially if the price was maybe a little bit less than it is today, or they've been raising dividends. Another way that companies can reward shareholders is through buyback. So instead of paying you cash, they can take some of their cash and buy back their own shares in the stock market, thereby basically inflating their positive earnings per share. Now, there are other ways that people, or companies, I should say, can invest their money. They could go and reinvest in their own business. They could hire employees. They could buy property. There are a lot of other ways to invest, but these are generally considered the two ways to really return capital to shareholders. Again, paying dividends or buybacks. Now, Tesla has talked about doing a buyback before. They've talked about possibly doing a $5 billion to $10 billion buyback. When you consider what this would mean for the company, though, with a market cap of $616 billion, if they buy back $5 billion worth of shares, that's only 1%. If we look at a lot of dividend companies, a lot of them will pay anywhere between 1% and 5%, depending on what kind of company. And that's a much more significant number than, 1% of buybacks. Now, a lot of people don't think that this is the best way for Tesla to spend their money anyways. Instead of buying back shares and, again, buying 1% of the supply, it'd be better to invest in more technology or invest in more gigafactories. There are a lot of different ways they can spend their money as well. So maybe it doesn't make the most sense because they might have a higher ROI to spend their money elsewhere. And kind of in the same way, less and less people would even think that dividends are a good idea for Tesla at this point, because dividends would probably be even less useful for investors at this point because they have to pay taxes on those dividends compared to just buying back their own shares. Now, as a company matures and there's less room for growth, typically companies do decide to pay a dividend. And that's something that, again, a lot of older investors, people that are closer to retirement that want that source of income, can appreciate. Now, that being said, Tesla doesn't pay a dividend right now. They aren't even looking at a dividend, but a lot of people do theorize, including one of the biggest bulls here on YouTube, Solving the Money Problem, does theorize that there will be a time where Tesla is making so much money, they have so much free cash flow that they will choose to pay a dividend. They're just going to be making hundreds of billions of dollars in profit, and they'll have to put it somewhere. And even doing as much as they can with gigafactories, even with robots, with the taxi network, they're still going to have a lot of free cash flow, and there's not going to be enough time to spend all of the money. So they may end up paying a dividend. As of now, though, they don't pay one. So if you want a dividend from Tesla, which, if you are a holder of Tesla, maybe you would use it to buy back more shares. Maybe you would use it to diversify into other companies. Either way, you don't have that opportunity right now because they just don't pay one. But there is a way to get money from your Tesla shares. And I've talked about this a handful of times on the channel, but I thought now would be a good day to remind everyone that you can do something called selling calls. You can sell basically the opportunity for someone else to buy your shares at some price at some date in the future. Now, if you've heard of this, great. If you haven't, we'll talk about it here for a minute. I have a full video actually on the home screen to my YouTube channel talking about how this is basically a hack to be able to make passive income from shares. I'll put it on the end screen too if you want to see a more in-depth video. But I pulled up Tesla here to give you some explanations for how you could get close to a 10% yield on your Tesla shares in a way that is actually pretty safe. Basically, it just takes out the very small possibility that Tesla explodes overnight. I'm not even talking about like a 10% move or 20% move. Like we're talking about 20, 30, 50% moves on Tesla in the next few days. It basically takes out the opportunity and it pays you for the opportunity for someone else to buy your shares at that huge valuation increase. So when we're looking here at Tesla, on my phone here. This is the Webull app, by the way. If you want to sign up for Webull, there's a link underneath the video so that you can do just that. And you can get access to this trading. I do like Webull for options. I specifically use it for options because I think it's really simple and easy to use. And they'll give you some free stocks too if you deposit $100. So when we look at a Tesla, right, we can look at the options chart here. The options are laid out pretty nicely here. You can do it a variety of different ways. We're looking at calls here, and if we go to 5 days out, you can see the strike prices on the left. You can see a lot of other data as well, but just follow me here. The price of Tesla is about $196 right now. If we go down to basically, let's say 237.5, right? So this line right here towards the middle of this, the delta on this is about 0.06. So basically there's a 6% chance that in the next 5 days, the price will go above this level. And keep in mind, this is a huge increase from right now. This is a 21% increase. Tesla would have to go up 21%. And then your options might be exercised. So you could get paid 41 cents per share or $41 for a contract for someone to have the ability to take your shares off you at $237.50. So basically your break even is the bid or the price that you get plus the strike price. So about $238 essentially is the break even. If Tesla's below that in 5 days, you are benefiting from selling this contract. If it's above it, then you lose out. But again, there's only about a 6% chance of this happening. So let's break this down. You can get $41, which doesn't sound like a lot. I realize that it doesn't sound like a lot at first, but you can get $41 and you can get this basically weekly. You could sell this every single week at $41. By the end of the year, you'd have $2,132, about $500 a quarter from selling this option. And basically, if the price goes up slightly, let's say it goes up to 220 by the end of this contract, right? You can bump this up so that it would be, again, about $40 or so above that price then. So if we're at 220, then you could sell it for about $260 and you get about the same premium. So you would make about a 10.8% yield throughout the year being able to sell this contract. And you would have to have Tesla move up about 21% in a week to have this option actually exercised. And again, that's not very likely. Now, of course, we could always look at a longer duration too. So we could go to the 26 here. So 26 days from now, and we can go down to $255 strike price. You get about $160 per contract. And again, that's per month. You're getting $160. And actually, it's a little bit shorter than a month. It's 26 days. So at the end of a year, if you sold this every 26 days, you would get $2,232 or a 11.3% yield. Now, in the month, there's only about a 10% chance that this would actually be called away from you. It would actually be exercised. So again, 11.3% yield. And again, part of this 10% likelihood is basically that it goes right above it. It could hit like $255.02. And that's part of that delta there. So you're giving up some of the upside, but again, you're talking about a 30% move in a month. Might be a little bit overheated if that was the case, and then we might see a dip too. So you might play perfect, and then you could have this exercise. It could fall right back down, and you could make out on both sides. You could get the premium, get the shares called away, and then it takes a little bit of a dip anyways. Now, this is all pretty safe, right? We're talking about 5% likelihoods, 10% likelihoods. What if you want some more upside or you want to get some more premiums? Well, something that I've done before with a very small portion of my portfolio, so only about 20% of my shares, a little bit less than that, I was selling contracts that were a little bit higher delta, so a little bit more likely to happen, maybe around 15 to 25% likelihood. So for example, if we look at this $217.5 strike price, there's only an 18.9% chance of this being called or being exercised. We would have to move up again about 11% in 1 week, so not super likely. And we would get $202 a week from this. Keep in mind, if we did that every single week throughout the entire year, we'd make $10,000, $10,504. So that would be a 53.6% yield. Now, at some point during the year, most likely, we would actually have that called. We might have to sell some puts and possibly get back into Tesla, maybe bite the bullet and just buy a little bit higher. But basically, you're guaranteeing that you're not going to have to get rid of your shares unless we move up 11% in a week. And you're also getting a premium on top of that. So you're talking about a 54% yield. And worst case scenario, it goes up 11% and you get your shares called. And then it keeps on racing up. Really, that's the fear for a lot of investors. The biggest fear is that Tesla, and I know this because I think Tesla has a very bright future. The greatest fear is that you think Tesla is going to go up to maybe $400 all of a sudden, or $300, because it is very volatile. That's part of the reason you get paid very well, very high premiums, is because there is a lot of volatility. So a lot of people decide not to sell contracts. They just decide to just hold on to their shares. But if you had sold contracts over the last year, you'd probably be doing better than if you just held onto your shares, because we have come down a decent amount. Now, I'm not saying to go do this with all your shares. I'm not saying that I do this with all my shares. The most I've ever used, or the most shares I've ever put up for this, or sold calls on, are about 20% of my shares in Tesla. Now, I do kind of think of this, though, as a nice last resort. Let's say everything dries up on YouTube, or my YouTube channel gets taken away or something like that. I have around more than 600 shares of Tesla, between 600 and 700. That means if I really want to, I could start selling options, start selling calls on 600 shares. So if I sold, again, that 5-day $217.5 strike price, that means since I have at that point about $115,000 worth of Tesla, if it goes up 11% in a week, that means I'd make out about $11,000 in a week in terms of appreciation. And I'd also get $202 times 6. So I get about $1,200 a week in premiums. So in the worst case scenario, I guess the shares fall, the appreciation comes down, I actually lose money, but I still believe in the company long term, and I get that $1,200 premium. That's the worst on paper, right, where my net worth goes down the most. The other scenario that people are worried about is Tesla goes up to $250 next week, right? And I have to sell at $217.5. I get a premium. If I'm really married to those shares, if I really want to hold Tesla, well, then I have to make the decision. Do I want to buy back way higher than what I just sold at? Or do I want to wait and then maybe it continues to move up and then I lose out in it? So I don't think this is the best scenario for myself, at least right now, to go sell all my options or use my shares for options right now, because I don't think Tesla is necessarily way overheated, and I think there's an opportunity for it to go up pretty quickly if the macro turns around, or if AI Day comes out really positive, or if they blow out expectations in the first quarter. So again, I'm not trying to get at the fact that you should go put all your shares up for this, but it is an interesting opportunity. It's kind of like a nice little emergency fund if you needed it to be, or some way to make some money passively. And it doesn't just have to be Tesla, but I think Tesla does offer some of the most attractive yields. Now, of course, some other really volatile stocks like, let's say, CleanSpark or Palantir, some companies like that do pay really high premiums as well. This, I think, pays better than most of the mega tech companies, or if not all of them, probably pays better than all of them. But you can also do this with dividend stocks. You can also do this with the S&P 500. You can do it in a variety of ways. But this just shows you that you can make a yield off of just holding shares. Now, of course, you have to give up something, right, to earn that yield. But it is an attractive opportunity for some kinds of investors or for parts of your portfolios. So if you want me to make more videos like this in the future, let me know. I'll leave the link to the other video where I actually break this down and show all the different kinds of scenarios for when you win, when you lose on the end screen. Thank you so much, and I'll see you in the next video.